Dhiraj Agarwal is now joining us. He's Managing Director at Ambit Asset and Asset Managers. He's in our studios. Dhiraj, good to have you with us here. Thank you very much for your time.
Thanks.
What should we start with? I mean, market's looking good. Looks like it's seeing through some of the troubles that we've had recently, and it wants to head higher. If it had to halt or drop, there's no dearth of triggers and reasons. It is not paying attention to any of that. What's your sense?
Yeah, I mean, it's gone into a phase where it seems like all news is good news, right? So if there is positive news on the fundamentals or economy side, it's obviously positive. If there is a little bit of a negative news on the global side, then the expectation that the rate increases will not happen and maybe the rate cuts will start sooner. And that gives you another bout of positivity. So at this point of time, that's what it appears. In fact, interestingly, if we see last 3 or 4 months, every month we have seen some amount of volatility intra-month. And the base that the market is sort of showing strength, that is almost 19,200 or 300 range. So just touches that level and bounces back. So long as that level stays intact, which is the base for the last 3 or 4 months, it's quite possible that market heads into a new high again.
Okay, we're not too far away from that, are we? About 100 points now on the Nifty. It's gaining quite a bit of ground. So this market is, less than 3% away from that all-time high that we hit a while ago. Dhiraj, hi, morning. The big sector that everyone will talk about over the next 24 to 48 hours is IT. How are you feeling about IT earnings this time, and how are you positioned on these stocks?
So at this point of time, I don't think IT will disappoint, because after the last quarter numbers, bulk of the weakness for this quarter is already baked in. At the margin, there could be 1 or 2 slight positive surprise, but I don't think there'll be too much of negative surprise from a surprise point of view. Nobody's expecting this quarter to be spectacular for IT. So IT, the whole debate on IT is now moved to FY25. FY24 is a bit weak, which is in the bag. And FY25 outlook or guidance, fortunately or unfortunately, will not come before, let's say, January or February, at least, or maybe even the March quarter. So for now, I think all the negative news in IT is broadly priced in. I don't expect too much of volatility in IT names into the result season, unlike the last one.
All right. Hi, Dhiraj. Good morning. Good to have you in the studio. You've launched a long-short fund as well. How you positioned yourself out there?
So at this point of time, we are long biased. At this point of time in the long-short fund. So as I said, Nifty looks like it took support at 19.2, 19.3. If nothing goes wrong, I think 2,500, 21,000 should be possible in the next 2 or 3 months. So we are positioned accordingly.
That's a very long fund. Long short fund.
No, we short as well. You
want to give us a rough ratio?
So our stock book is at this point of time about 11 or 12% net long. And so our book is in 2 parts. So we have the stock book and the Nifty book. Nifty is more tactical. And they're completely uncorrelated strategies. So stock book is 11, 12. We might go up to 14, 15. That's about the maximum we plan to go to, although the framework allows us to go to plus 30. But Nifty, we are long, about 50 or 60%. So if you actually add Nifty and stock book both, we are at this point of time about 70% long.
So what is that? What makes up that 13, 14? I mean, you said you go up to 14%. Are you at 14 or a little lower?
No, we're about 11, 12 right now.
So what makes up that 11%?
In terms of components?
Yeah, because give us a broad idea, because in a market like this, to even find that 11% to go the other way would take some conviction. I mean,
on the short side, even.
Yeah. You really have to dislike something.
See, not really, because actually we see in the last few months, even this year and last year and a half, the dispersion between sectors and stocks is far too high. So if you look at banking as an example, which is my favorite example because it's about 38, 39% of the index. When this year Kotak and HDFC Bank are negative, they're actually down in absolute terms, not just in outperformance or underperformance terms. Whereas last 3 months itself, PNB is up 25%. So there are opportunities. You're right, trying to make absolute returns from the short book is a little tougher. But one can make a little bit by picking it rightly. So 2 things, 2 key variables which is working in the near term at this point. Markets chasing growth, right? So, and market is willing to take slight amount of additional risk for chasing growth now as compared to, let's say, a few months ago. And in the BFSI space, again, to take that as an example, we see NBFC is doing really well because they're growing the book at 25 to 35% range. banks beginning to struggle because they're growing the book at 14-15% range. So this is literally like the pre-2010 market, where people used to look at just two matrices, which is what is the relative growth, either with the market or within a sector, and what's the relative valuation. So this typically happens when retail money becomes dominant force, which is what we are seeing at this point.
Okay. There are some pockets which are coming back in a big way, right? And it's perplexing because it's after almost a decadal slowdown you were discussing that real estate is back and how. But for someone who's perhaps missed this bus entirely, is there still more to go? Is this a structural uptrend?
I think so. So if you see, even if you look at the component of retail credit in the last 1 year, now apart from the unsecured retail credit, which is growing at a very fast clip, 28-29% YOY, the other segment which is actually growing very strong structurally is home loans, growing at about 17-18%. So that's one place where we see a bit of a structural demand situation at this point. Not so much from an asset price point of view, but from an actual demand for usage point of view. So it's the current real estate cycle is a little bit different from what we saw in, let's say, 2003 to 7, where a lot of investment demand was going into real estate, and the real estate prices were rallying at 30, 40, 50% per annum, right? So I heard before I came in, you talking about that you just bought an apartment last year, right? Last year or 2 years ago, but you were planning to buy in 2014.
Yeah.
So I bought mine in 2005.
Lucky guy.
It was really lucky because in 4 years it was 3x.
Yeah.
So by 2005 to 2007 it was 3x, and it's been at the same price ever since.
So all of us have been in the same boat.
So I was lucky to have bought a house at that price.
Yeah.
But as an investment return, it's
nothing.
It's just flattened out, right?
And for someone who's in the equity markets, right, it's painful to see an asset, a clunky asset, not giving you as proportionate returns as equities. So.
True, but at the same time, you need a place to live. And I was a little tired of moving homes every 2 or 3 years because it gets a bit painful.
Just look at other areas and you feel better. I mean, it's somewhat worse off, so it's okay.
Dhiraj, let's get back to some of the domestic cues, though. We'll have a state elections, quite a few that will play out as well. And the markets could be a little jittery out there.
Right.
What's your view if the outcome isn't, in select states, the current ruling central government? Because 2024, we are betting on Prime Minister Narendra Modi to have continuity and continue with all those policies. Your view?
So two things. One is markets already entered into a volatile phase. It's no longer as linear as what we saw for a few months in between. Just to quote another statistic, in the month of September, while small cap index was up about 2.5 or 2.3%, the median number of stocks within the small cap index actually closed in the red for that month. Even Nifty, last month we saw almost 5% up in the first half of the month and giving back almost 60% of the gains in the second half of the month, closing 2% positive. So the volatility phase has already started, although the trend is up. If you zoom back a little bit and look at the data, YTD Nifty is up only 8.5, right? It's not spectacular. Since Jan of 21, we are up 13 or 14. Again, okay, but not spectacular. Put things in perspective, S&P 500 is also 14% over the same period. So the entire so-called India growth story is at this point of time playing out more in the mid-cap space and small-cap space as compared to the large-cap space. So you're right, events like elections, events like the unfortunate event like what happened in the Middle East this week or over the weekend will make the markets more volatile. And it is certainly a time to be a lot more selective and the real stock picking skills will now work as compared to just buying anything that you wanted to buy.
Okay, Dhiraj, just before we let you go, actually we have a very interesting discussion lined up with the management of Keystone Realtors in a bit. So and your view on real estate is that there could be a bigger upside from here, correct?
Yeah, more demand perspective. I'm not that positive on the prices galloping the way they did in the previous cycle, but demand is solid.
Okay, I would love you to listen into that discussion as well.
Sure.
We are going to have it in moments from now. So in case you need, you have any questions of your own, you're free to ask the management. So